Miguel Angel Sanudo brings up a really good question, which we didn't even touch on the stock market, right? Miguel Angel asks in the chat, isn't it that real estate and stock market work in opposite trends for investors, all depending on the economy? I go ahead and answer that, but I think it'd be interesting for you to talk about what you would have experienced by having invested in the stock market, and what the key differentiator that you kind of like shook me up this morning were like, dude, you're just thinking about it wrong, of the difference between investing in the stock market and investing here.
Yeah. So most people feel like that the stock market and the real estate market are maybe indirectly correlated, right? If the stock market goes down, real estate's going to go up, or vice versa. Most people would be really shocked to know that when you have a recession, right? Generally, recession is about GDP, right? 2 consecutive quarters of negative GDP growth is how you define a recession, but you generally have the stock market go way down, right? So you would assume that in most recessions, you probably had some loss of stocks. That is not how it's correlated to real estate, right? In 4 of the past 5 recessions, real estate values in Jacksonville have actually gone up on average over 3% in 4 out of the last 5 recessions. The one recession where it didn't happen, which one was that, Pablo?
The Great Recession.
The Great Recession, which was caused by real estate. So it's actually not correct to assume that the stock market and real estate are correlated, right? Real estate prices, as we've just talked about, are based on supply and demand. Obviously, other factors play into it, right? If there's a huge loss of wealth, that might decrease the buying power and decrease demand. So there's some correlation, slight correlation there, but for the most part, it's supply and demand. And so your real estate market can operate independently of what the stock market does, and that's just kind of what we've seen through recessions in the past. But we were talking this morning, Pablo and I were talking to him. He's like, well, what do you think you would have, if you had put that money in the stock market? What do you think your returns would have been? And I kind of paused for a little bit, and I was like, the way the stock market works is, given a long enough cycle, right? Your stock gains most likely are going to be somewhere between 7 to maybe 9%, right? Which is pretty similar to what your returns would be in real estate if you're investing in all cash long-term, right? So in real estate, if you're investing in all cash right now, I would tell you to expect about a 5.5% return from the cash flows, and tack on 4% appreciation. You're looking at like 9.5%. So if we're looking at what the real return on investment from the stock market would be over the long haul, and the real return on investment from real estate over the long haul, they're, from a return perspective, if you're buying in all cash, they're pretty similar, right? Which might be surprising that you might hear that from a real estate guy, all right? But there's 2 main differences, okay? Number one, it's the type of income that is coming to you. So in the stock market, it's purely based on speculative gains from the asset appreciation, right? Your stock price going up. You don't get much money or any money from dividends on a monthly basis in the stock market. So there's a huge value for that, right? There's a value for all of us who are real estate investors to actually get the cash every single month. So you might be getting somewhere around 7 to 9% for the stock market, but it's speculative. You're not seeing that every single month. Whereas in real estate, if you're buying in all cash, maybe it's about 9%, including appreciation, but you've got 5.5% of that coming in cash flow every single month, which really matters. So that's one point. It's the type of return that's coming to you. And then the second point is the ability to acquire smart leverage. In the stock market, you're stuck between hopefully 7 to maybe 9% returns over the long haul. Right? It's going to go up, it's going to go down, but the average is probably going to be between 7 and 9% over the long haul. In real estate, and this is why we talk so much about using smart debt, what I was sharing with you about that 9% return in real estate is assuming you're buying in cash. If you buy that property using smart debt, your down payment is a lot lower. Your initial investment is a lot lower, maybe 20 or 25%. And when you experience growth, that 4% growth from appreciation that I've been talking about, it skyrockets your overall return on investment. So that's why we work with clients. And when it's the right thing to take on financing, That's why we look at it and we say, if you're invested for the long haul, then you can count on home price appreciation. You use debt, your returns can be between or over 20% on that same asset. So it comes down to those two things. It comes down to the type of income coming to you, and then it comes down to your ability to acquire smart leverage that you get with real estate that you don't get in the stock market.